Imagine stepping onto a roller coaster, blindfolded. You wouldn't know the dips from the climbs or the turns from the loops. Well, in many ways, that's investing without understanding the economic cycles that drive our markets. But today, right here on Investing Path, we're taking off that blindfold. Ray Dalio, the mastermind behind Bridgewater Associates, one of the largest investment firms to ever exist, isn't just making waves. He's meticulously mapping the ocean of our economy. He doesn't just look at the market fluctuations of the last decade. He zooms out, studying the seismic shifts of centuries to pinpoint where we stand and where we might be heading. The question we all have is, what's next for the economy? And more importantly, how do we adapt our investment strategies to prosper? Ray Dalio suggests we're at the brink of profound changes, ones that could redefine wealth management as we know it. Let's peel back the layers of this economic onion. For starters, consider the global debt crescendo. Governments have long used debt as a financial tool, but recently, they've taken to it with unparalleled zeal. And with each dollar borrowed, we inch closer to a tipping point, one where the sheer weight of interest payments could drag the economy down. Now, if you're picturing a giant vault where all this borrowed money is stacked, you might want to think again. In reality, it's a complex dance of bonds and interest rates, a balance of supply and demand that, if tipped, could send shockwaves through our financial system. Imagine the repercussions if investors stop showing up to this bond-buying bonanza. Interest rates could skyrocket, an outcome we're hardly prepared for. Now, let's not overlook the political stage, where the drama is more than just a spectacle. It's reshaping the economic narrative. The widening rift between political ideologies isn't just fodder for news outlets. It's actively redefining policy, and in turn, your investment portfolio. Then there's the technological titan, artificial intelligence. It's not just changing the game, it's rewriting the rulebook. Investing in technology requires foresight. You need to separate the wheat from the chaff, the Amazons from the Yahoos of the 90s tech bubble. In the crucible of current affairs, holding cash has regained its charm. With interest rates offering more than a mere pittance, it's a sanctuary in the storm, part of a well-rounded strategy. But, as with all things in finance, it's a delicate balance. Too much cash, and you miss the growth. Too little, and you risk the tumult. Now, let's expand on those historical economic cycles. Consider the Roaring '20s, an era marked by rampant speculation and a stock market bubble. It's a textbook example of what happens when exuberance outpaces reality. Fast forward to the Great Depression that followed, and we're reminded that the pendulum always swings back. But here's where it gets interesting. Each cycle offers lessons. The recovery post-World War II, with its surge in industrial production and global trade, set the stage for the golden era of the 50s and 60s. Studying these patterns teaches us that economies are phoenixes. They may burn, but can also rise from the ashes. In our current climate, let's not forget the 2008 financial crisis. The collapse of Lehman Brothers wasn't just a failure of one bank. It was a domino effect that nearly brought down the global financial system. The lessons from that crisis are still reverberating in policy and practice today. It showed us the danger of over-leveraged financial positions and under-regulated markets. As we journey through these historical signposts, it's crucial to align our investment strategies with the lessons they impart. For instance, value investing, popularized by Benjamin Graham and later by Warren Buffett, teaches us the virtue of patience and discipline. It's about finding stocks that trade for less than their intrinsic values and waiting for the market to recognize and correct its undervaluation. But how do we apply these lessons to our contemporary setting? One way is through scenario planning. Envisioning various future states of the world, like continued low interest rates or a sudden spike in inflation, can help us allocate assets that perform well under different conditions. On the international stage, we're seeing a shift in economic powerhouses. As U.S.-China relations continue to oscillate between cooperation and confrontation, the economic implications are vast. The trade policies that come out of these relations can impact markets worldwide, influencing everything from currency strength to commodity prices. Investors must keep a keen eye on these dynamics, as they can alter the risk and return profile of different market sectors overnight. Moreover, we're witnessing a renaissance in green technology investments. The push towards sustainable energy sources isn't just an environmental statement, it's a burgeoning market sector. The rise of electric vehicles, solar panels, and wind energy is more than a trend. It's a transformative shift that is opening up new investment frontiers. Artificial intelligence, which we touched on earlier, is not just another tech sector. It is the very embodiment of the fourth industrial revolution. From automating stock trading to revolutionizing medical diagnostics, AI is rapidly becoming the backbone of innovation across industries. The investors who can discern the AI ventures with true disruptive potential from the ones with hollow promises will be the ones who reap the rewards. And now, let's circle back to the topic of cash. It's worth noting that cash isn't just a defensive asset. It's also ammunition. Ammunition to take advantage of opportunities as they arise. Think of the investor's maxim. Be fearful when others are greedy, and greedy when others are fearful. Holding cash means you're ready to pounce when the market presents an opportunity, such as a temporary dip caused by short-term uncertainty. Finally, let's talk risk management. It's not just about avoiding losses, it's about understanding your own risk tolerance. How much volatility can you stomach? Does a market drop keep you awake at night, or do you see it as a sale? Your investment strategy should mirror your risk appetite, balanced with your financial goals. But before we conclude, let's delve a bit deeper into the concept of risk and opportunity in a fluctuating economy. Risk is not a one-size-fits-all metric, and neither is opportunity. It's crucial to tailor your approach to both, based on evolving economic indicators and personal financial milestones. For instance, younger investors may have a higher risk tolerance, given their longer time horizon, whereas those nearing retirement may prioritize capital preservation. Diversification is often touted as the investor's main defense against risk. But let's clarify that it's not just about spreading your investments across different sectors. True diversification involves a mix of asset classes with varying correlations. This can include stocks, bonds, real estate, commodities, and even cryptocurrencies. Each asset class responds differently to economic changes, and a well-diversified portfolio can help smooth out the ride during turbulent times. And let's not forget the importance of continuous learning. The investment landscape is constantly evolving with new financial instruments, regulatory changes, and emerging markets. Committing to education, seeking out expert insights, and engaging with a community of fellow investors are essential practices for staying ahead of the curve. As we draw this session to a close, it's important to reiterate the value of patience and perspective in investing. Markets may fluctuate, but a long-term outlook, grounded in historical wisdom and a clear understanding of economic cycles, can help you maintain focus and avoid the pitfalls of reactionary decisions. With these added layers of knowledge and strategy, you're now better equipped to navigate the complex world of investing. We at Investing Path are dedicated to illuminating the twists and turns of the market, empowering you to make informed decisions that align with your vision of financial success. Thank you for tuning in to Investing Path. Don't forget to subscribe for more insightful content that can help you decode the signals and signs on the road to investment mastery. Until next time, invest wisely and stay informed.